it's very difficult to figure out whether this started before the current, tariff drama or after, although the news reports suggest this has been on the table. This is nothing new, frankly. Apple's app stores have been under scrutiny globally for some time. We've already remember the drama with the Epic Games and what's happening in the US. They brought it down to 27%. That case is up for hearing it very soon, so that's going to be a problem. EU is already down that throat, and then now China. So it seems to us that on the long run, these fees need to come down, and that's really not a good thing for them because App Store fees and the services revenue is very high margin for Apple. So it's not a surprise that stock's down 1.5–2%.
And it's down 8.5% year to date. It's only up 22% over the trailing 12 months, trailing a lot of its peers pretty dramatically, I would argue here. So as you model it out, Anurag, and as other analysts and investors model this out, what could it do for the growth rate for the services business? I mean, again, that 30% cut, you could argue the validity of it, but that's a big number.
It is a big number, and if you see Apple's growth rate right now, 4, 5, 6%, somewhere in that range, bulk of it is driven by services business, which in the most recent quarter was up, I believe, 13–14%. So, taking that down really has a big impact both on profitability and top line sales. And then, you did mention it's down 8.5% year to date, but when you look at it on a valuation point of view, a company like Apple growing 4–5% and PE of 30.5, while Microsoft is at 29.6. So there is a lot of discussion around whether people should be paying that level of multiple for sales growth of roughly around 5%, which by itself is under pressure because of all the legal scrutiny or the regulatory scrutiny.
So to that point, it also seems to highlight, though, the China risk. Like they have the China risk when it comes to device sales. Now they have a China risk when it comes to services spend. They would spin it, right, as like, ooh, but India is this big growth driver. But is that really actually a pivot that is happening?
No, I mean, it is happening, but India is so small compared to China, frankly, from a units point of view, that it is not even a comparison, frankly. It may take 7 to 8 years before we could come up with an hypothesis that it can take over some of the fall from China. But all the emerging markets together can take up China, or in a sense, if there is any loss of revenue from there. But India by itself is not the big growth story. And again, I think a little bit of this is political too. We heard yesterday that China is reviewing some of Google's policies as well, and so it's just a matter of, I think it's just going to be unfortunately a problem for a lot of U.S. companies and Chinese companies if we do get into this political back and forth between the two super nations.
Is it a reasonable bear case, Anurag, to say this China headwind, it is at the very least a 2, 3, 4 year type of thing? This is not a short-term thing, and then as a result, you really can't own this thing?
I mean, it's the thing is, Paul, the question on that is, this always known. I mean, this is not something, I think this really came up in prominence in the last, tariff war. In fact, if I go back and look at my write-up on Apple, in those days, I really wasn't focused on China risk at that time. I was like, yeah, it goes up and down. But frankly, I've been so focused on that. If you look at our write-up on Apple today, bulk of it is driven by the risk on China. So absolutely, amongst the top 7 names, I think this is the one that's most exposed to anything China related, tariff related, political related. This is such a you could say unknown and hidden risk that people need to know it very clearly before they buy the stock.